Hi everyone. Let's go over this supernormal growth stock valuation problem. It's the self-test problem 8 in the 12th edition. Okay, we're dealing with Snyder computer chips and they're experiencing a period of rapid growth. Earnings and dividends are expected to grow at a rate of 15% during the next 2 years, at 13% in the third year, and then at a constant rate of 6% thereafter. The company's last dividend was $1.15 and the required rate of return on the stock is 12%. And we're asked to compute three things: the value of the stock today, the price of the stock a year from now and 2 years from now, and the dividend yield and capital gains for years 1, 2, and 3. All right, now to save time in the demonstration, I've worked this ahead of time and I'm going to show you how I would solve this primarily using the Excel's NPV function rather than using present value formulas and present value of an annuity formula. But you'll see I'm sort of doing that as we approach this one. All right, let me get started here. And I've worked it ahead of time. First, we drop in the time periods, right? So let me drop in the time periods. And I'm hitting the color screen above, which is why you're getting some flickering. Okay, and then what I'm going to do is drop in the interest rates that apply, and it's 12% because they tell us the required rate of return is 12%. And then I'll determine the value of the stock today using NPV. Well, the first thing we have to do is determine the dividend a year from now. And how we'll do that, you can look at it, the formula up here, or if I hit the F2, you see it here. So you can see it here or there. It's $1.15 times 1.15 to determine what next year's dividend will be. Then the year after that, we have to take the previous year's dividend times 15%. And in the third year, we take the previous year's dividend by times 13%. And then the fourth year, the previous year's dividend goes on forever. So we'll calculate that as the perpetuity portion or the constant growth portion of what we're expecting to find in dividends. So the only place we have a calculation here is at the end of year 3. Okay, and what we need to do at the end of year 3 is we have to take the value of the dividend at the end of that year, multiply it times the percentage increase we expect for the next year, right? And it's 6% at that point. And then we divide it by the rate of return less the growth rate. So we are using one of the formulas to calculate what the perpetuity is. And what we are essentially using is the formula for a perpetuity where we're experiencing growth over long periods of time. So we take the required rate of return less the growth, drop that in the denominator, divide it by the constant payment, and that's our modified perpetuity that accounts for growth. Okay, and that comes out to be 30.36. Now, actually, this should be expressed in a dollar sign, if I can get the decimals going the right way, and so should that, since it's the first time we're seeing a number at the top. Okay, and then all we need to do here is sum across. You'll see that's all I'm doing, summing across. And once we do that, we have all the cash flows we need. You'll see at the end of year 3 we have the cash flow of the dividend at the end of the year plus the perpetuity portion that accounts for all the years going forward. Now, don't make the mistake in thinking that the perpetuity goes at the end of year 4. It doesn't. It goes at the end of the first year where you're calculating the constant growth and then going forward. Okay, so that's an easy mistake to make, is to think this one goes in year 4 when it really goes the end of year 3. We discount to the first point where we have continuous growth going forward. Okay, and then we drop in the NPV formula, and that will give us the value of the stock. So how do we do that? We take the NPV, the net present value, assuming a 12% rate of growth, and the cash flow stream that we've calculated, and we come up with 2523. So that's how I would use Excel to come up with the value of the stock today. All right, now let's move on down and tackle the value in later years. And then we have some new asked us to answer for column C. All right, well, essentially all of this looks the same. Now let me drop part of it in here to show you what I mean. And we would calculate NPV at the end of the next year. Now what you see is I just dropped off the first year because now we're in the next year, so the cash flow we expect is the $1.52, right? And all we're doing is we already calculated it from above, so we just drop it in. The next cash flow, the perpetuities are the same, right? And we discount the cash flow a year from now to see what would the value of the stock be. And you'll see that it grows, okay? To calculate the dividend yield, now when I say it grows, it's now 26.93 instead of 25.23. The dividend yield, we just take the difference in the stock price. Or, excuse me, we take the dividend in year one and we divide it by last year's stock price, right? Keep in mind we were calculating the value today, so the dividend of the next year by the beginning stock price gives us the dividend yield. And then if we wanted to calculate the capital gains yield, we take the difference in the price between the 2 years divided by the beginning price. If we add those together, we equal our expected rate of return or required rate of return of 12%. Okay, I'll slide on down so we can finish this up, and you'll see in the third year we're doing the exact same approach, but now we only have, we're trying to calculate the end of year 3. This is the end of year 1. This is the stock price for year 1. This would be the stock price. Yeah, I'm still saying that incorrectly. This is the value of the stock today. This is the value a year from now, and this is the value 2 years from now. And if we want to calculate the dividend yield and capital gains for years 1 and 2, and I probably should have done years 3 as well, but I've only done 2, so we'll look at that this way. What we come up with is exact same calculations, only now we take next year's dividend divided by the by the sales price at the beginning of year 1, and we're able to calculate what that dividend yield would be. Then we can calculate capital gains the same way. Take the difference in what the price did from this point versus a year ago. And again, we add it in 12%. So the only part of this exercise I'm not going to answer because of the time would be the dividend yield and capital gains for year 3. But you certainly could calculate that going forward. Okay? And that wraps up this problem. I hope you found that beneficial.